Let's have a look at investment properties then. So first of all, what is one? Well, if you have an investment property, you've probably bought it because you want to rent it out, or you're not too fussed about renting it out because you think the value is going to go up. So you're either holding it for rental income or for capital appreciation. What it's not though, it's not a building that you always do this to, that you hold them for sale, because if you're holding them for sale all the time, you've got lots of these buildings, it's effectively stock, isn't it? IAS 2. Or it's not something that you use for admin or production, because if it is, it's normal PPE to use, so that would be IAS 16. Now, there is a slight difficulty here. It could be that, let's say you've got a 10-floor building, 4 floors you rent out and 6 you use. Well, you can, what we call a dual purpose building, well, the 4 that you rent out, treat as investment property, and the 6 that you use, treat as PPE. Simple as that. So, what about the values? How much do we bring them in at? So initially, with an investment property, you're going to bring it in at the cost, including the legal fees to get it, etc. And if you're building it yourself, construction costs up to the date of completion. And then subsequently, this is very, very rare, you would bring it in using the cost model of investment properties. And that's cost less depreciation. But that's very, very rare, and only when you can't get the fair value reliably. But you would still try and disclose that fair value if you possibly could. But it's very, very rare, the cost model. So investment properties, I want you to always think, well, it's virtually always the fair value model. And you revalue it to the year end. And because you're going to revalue it to the year end, it's going to go at the year end. It's going to go from like 100 to 140 or 100 to 80 or whatever. So you change the value of the building, but where does the difference go? Well, it doesn't go to the OCI. It doesn't go to revaluation surplus. It goes to the P&L. Yeah, and just a reminder, of course, if you value something, there's no depreciation because the fair value lift and downward fall takes into account the depreciation. So overall, I want you to remember the basic rule is fair value model is virtually always used. You revalue it to the year end each year, and where does the difference go? To the P&L. Okay, so far so good. Then we have the tricky bits of the change in use. Again, the basic idea is, let's say you're going from PPE to investment property, you're going to using it, now you're going to rent it out. Well, you have to bring it in at its fair value, and therefore any gain would go to the OCI, or a loss would go to the P&L if there's no OCI to use that up. That's the basic rule. And if you were going t'other way round, if you're going from investment property to PPE, then you're going to have a value in your investment property. You're going to change it to PPE. You're no longer renting it out. You're now using it. So whatever value you had it in your accounts at, that becomes the deemed cost for the PPE. Then you start depreciating it or doing whatever your model is for PPE. Okay, hope it helps.